Good morning, everyone. My name is Ruben Valentino, and I am the VP for Trade Corporate Sales at Banorte. It's a pleasure to join you here at BAF 2026 International Trade and Payments Conference. Today's panel, The Future of Supply Chain Finance, comes at the moment of real transformation. Regulatory pressure, geopolitical shocks, fintech competition, digitalization, and sustainability requirements are reshaping how institutions think about SEF. At the same time, AI-driven risk assessment, data visibility, and regionalization trends such as nearshoring are opening new opportunities for growth and resilience. Our goal today is simple: to understand where supply chain finance is heading, what banks and suppliers must do differently, and how we can adapt in a market that is expected to grow potentially double by the 2030s. I'm joined by three outstanding speakers in this space, and I'm honored to guide today's discussion. Our first panelist, Christian Hauser, Product Head for Structured Trade Finance Solutions at Deutsche Bank. Christian brings over 20 years of experience across cash management and supply chain finance, and has contributed extensively to industry standards, including the standards definition for supply chain finance and the open account section of the World's First Principle. He also chairs the Global Supply Chain Finance Forum and serves as a technical advisor to the ICC Trade Register. Next, we have Yahaira Soto, Regional Head of Implementation for Europe and the Americas within Global Trade Solutions at HSBC. She has more than 2 decades of experience in the financial sector with deep expertise in project management, risk management, and large-scale trade implementation programs across major markets. And finally, Kel Tyndall, Global Head of Value Delivery and VP of Program Management at Prime Revenue. As a member of the Chief Leadership Team at Prime Revenue, Kel spearheads building systems and processes that enable teams to be successful as the leader of customer success. He works with multinational and mid-market organizations across all industries to achieve their strategic supply chain initiatives with the support of Prime's revenue line of B2B payment solutions and services. So, we have between 4 and 6 questions. Hope we get enough time to answer them. So the first question is, the supply chain finance market is projected to grow significantly toward the 2030s. In your view, what are the key forces driving that growth, and which risks are still underestimated by the industry? Who would like to begin?
Yeah, I'm happy to start. So I actually think one of the key forces that continues to drive SCF is the original force that was driving SCF, and there's still a tremendous amount of weight and pressure on working capital, and so that continues to push. Additionally, I think what we're seeing is the broadening of what was originally a very specific scope around SCF, like a specific set of suppliers that are strategic and make sense for this. That has continued to grow and expand across larger and larger groups of suppliers. So not only are we getting deeper penetration into trade, we're also seeing a broadening of the actual products across supply chain finance. So not just sort of reverse factoring anymore. It sort of starts to press the edges of that as innovation enters the space. So I think that's a big growth factor right now. And we'll kind of get into the technology piece and broader there, but the risks, I think, continue to be complacency. So complacency in the market, and then the opportunity and the risk, both around transparency and regulation. So those will all sort of continue to be really interesting, and I know the following questions, because I got to see them beforehand, will sort of flow into that. And so.
Yeah, I'm going to jump on the IT a little bit because I think that's one of the main driving forces. We're seeing a lot of ERP integration, right? So advances there as well as in APIs, cloud-based solutions, AI-assisted technology, all of these digitization. It's driving onboarding, right? So it's lessening, reducing the friction within the onboarding process and giving visibility that you haven't seen before. So that's really making the supply chain finance efficient, scalable, and just really attractive to a broader base in the banking. And I think one of the main risks that we tend to overlook is operational and data risk. So while there's a lot of buzz around AI, you really have to know that the data, if there's a lack of data quality there, and I'm talking about like ERP feeds not being consistent, I'm talking about supplier details, also incomplete, approvals outside of systems. So these things undermine the analytics that we need for supply chain finance to be successful. So I think it's really underestimated from that point of view.
Thank you.
Sure.
Chris, I would love to how you see it.
Well, what can I add to what has been said? I agree there are ample opportunities in terms of growth, driven by shift of supply chains, the general economic growth. In spite of all the tariff discussions we are seeing, there is an increased interest in supply chain finance. Also, when we look into smaller companies, whether it's smaller companies as clients or smaller companies when discussing the infamous trade finance gap, also in the context of deep tier financing. So there is actually a lot of growth potential. In terms of risks, I see a couple of risks. We had a panel yesterday on fraud, and we all know there have been recent cases, one which was really prominent in the past, the First Brands case, but we also had others we all know, like Abengoa, Carillion, others. I leave out Greensill, that was a special ball game. So this is risk. It's driven by, I would say, lack of knowledge on the business. The investors do not necessarily understand what they are investing in. There's too much greed. So that's obviously a risk. Then the other risks I see is on the regulatory side. We have ambitions from some governments to limit payment terms. We see trends towards KYC, also on so-called counterparties, which are the suppliers in a payables finance context. We also have changes in the regulatory frameworks when it comes to IFRS and US GAAP. That's not about accounting, it's only information. But clients are very concerned about that there might be an impact on accounting, albeit it's really only disclosure, it's information. But there's a lot of discussion about that. So from an industry perspective, I would say lots of things to do, lots of things to look at, to monitor, and to do advocacy work.
Thank you, Chris. I think we can stay with you because the next question is regarding regulation, transparency, and compliance. Regulation and transparency expectations have increased sharply in recent years. How are institutions adopting their supply chain finance frameworks to meet these requirements while still scaling programs? Who would like to, maybe Chris or Jahaira?
Sure. So what we're seeing is compliance being embedded within supply chain platforms at the forefront rather than as an afterthought. And I think that's really important in this day and time because that's the automation of KYC, AML checks, sanction screenings. All of this really gives a benefit towards automating the process, taking out manual risks from there, and really enhancing the risk opportunity or framework on looking at these things. So I know you're gonna really get into the other aspects. I'm coming from a digital aspect, but those things are really helping. That automation is really helping with the risk reviews and what you can focus on from a risk perspective, highlighting those things quickly. And then, like I said, taking out that manual risk that's there.
Yeah, Kel.
Yeah, sure. From a sort of a fintech perspective, I think the ambiguity around ongoing regulation is probably another good risk to the growth in the industry. In that, and Chris, to your point, the customer really needs the clarity to understand how to move forward. I haven't met a customer who's unwilling to expand as long as they understand that the rules are clear and the regulations are clear. So I think with the additional regulations becoming clear, we end up in a position where we can make transparency more available. And so that becomes where SCF as a framework ends up being more of a service to the customer to help them meet regulatory and compliance guidelines. So that's a big aspect of platformatization across the board that we've seen in SCF over a period of time, and that'll continue to advance. I think it gives platforms particularly an advantage in the adaptability and ability to expose transparent data and be able to leverage different mappings to stay compliant in relation to the agility and volatility that changes in the real world. So that ends up being a really clear indicator of agile fintechs working with banks or banks building out technologies that end up being agile. But it's a constant game of monitoring how are regulations changing, how are payment term regulations changing, and how are we advising customers, and what structures can be put in place that support that, or what structures can be put in place that circumvent that, in addition to FASB guidelines or other disclosure guidelines where we're really just exposing data, but those are still really in their infancy, and they're not detailed enough to really provide guidance into what that's going to turn into next, which is going to be accounting. And we still see some agencies making their own determinations sort of independent and stating if you have a certain amount outstanding or certain payment terms beyond a certain date, they're now reclassifying that as debt, even if it's not going to be based on the actual accounting treatment. So I think it's all a really interesting space. It's all going to continue to evolve and adapt, and everybody is going to have to be incredibly agile to keep up with it. So I think that's kind of the basis of thinking with the product in mind first, and leveraging the technology to do a lot of that work for you.
Yeah, let me maybe add my thoughts, particularly on the disclosure. I believe that's a topic which kept us busy over the past 1-2 years, from an industry perspective even longer, because we had all those discussions with FASB and IASB. I think what's really important is, I mean, we all understand the ambition behind it. Yeah, there was criticism from the analysts, and then the Big Four stepped up to the organizations, and then we had this reaction. Okay, we need to create these disclosure rules. I still believe that the complexity of this has been a bit underestimated. Particularly, I mean, most of us are serving big clients, global clients, and it's easy to come up with these requirements, but when you really go into the details and realize, this is a client who has payables finance program running at, 3 banks across 3 regions and 20 currencies and across 50 or 100 legal entities. Good luck with that. Someone needs to collect all these data from the different providers in different formats, put everything together. I can only think to myself, the poor auditor or the poor treasurer who needs to put all that together. There is a certain standard in terms of output, but when you really go into the details of how each and every program is set up, there are some slight differences sometimes. So that's a challenge, right? The other point, which I came across recently, was an interesting one. I spoke to a couple of clients, and one client said, look, we have our supply chain. It exists for years now. We procure in Asia, goods are delivered to us, they go by container, it takes a while. Then we produce our stuff, we put it at the retail store, and we have agreed a payment term with our supplier of, let's say, 120, 150 days. It's industry typical, no one is criticizing it, absolutely accepted. Supplier is also fine with it. We have a payables finance program in place, everything's working, everything's hunky-dory. Now we have the disclosure rules. And analysts, like S&P, for example, step up and say, oh, that's longer than 90 days, that's bank debt. And they say, why? It wasn't bank debt before. Just because of the disclosure rules, you're now saying it's bank debt. That's not true. So that's something, all these ramifications of these disclosure rules, I believe, have been a bit underestimated. So We will see how it further evolves. I think we are at the very beginning of a phase now, well, it's a learning curve. So to be monitored.
Thank you, Chris. We have some doubts from the audience, but honestly, I would like to jump to the next question because I think it would be a healthier debate. I like this is the question that I like the most. Banks are facing increasing competition from fintechs, but also forming partnerships with them. How do you see bank fintech collaboration evolving within supply chain finance?
I think you said it really well earlier.
Yeah, it's okay. We're just saying, me and him were talking earlier, and it's really about partnerships. That's what you're seeing more and more, and that's going to be important. Bankers are not IT, so it just makes sense to partner with the fintechs. They bring the technology, we bring in the funding, we bring the regulatory aspect and the client relationship. That's going to be important, right? And it's not just leveraging them from a client aspect to provide that availability there for clients to be flexible for them, but it's also to look at other ways to use the technology that fintechs bring to the table. So what risk tools there are so we can make better assessments and just look at supply chain finance holistically. So it's really leveraging that technology base as a partnership and working with them on how to scale.
Yeah, I 100% agree. I think the way that we look at it being a fintech is that the financial institution and banks are one of our customers. It's not really different. We look at it from a very partnership standpoint. We are there to fill a need for that particular customer and vice versa, where we need credit to be able to deploy it if we originated something. But generally, that's how we look at it. When we look to our banking partners who hold very strategic relationships with customers and how we can help get to the outcome the customer is looking for. So we're taking especially in the future, we're taking and looking forward, and since the title of the session is this, we're taking a very customer-centric look at this. And the future of supply chain finance sits with those corporates who want to push this forward and continue to grow. And we need funding institutions and partners to do that with. So from a competition standpoint, I think that's a little bit of a different animal if you're looking at fintechs who are raising capital and kind of doing that on their own, versus the fintechs who are really standardized in this space and agile in providing really clean service, collecting all that data. I think, Chris, you made a good point. If you had a single platform where you have all these different programs operating through the same framework and you can collect all that data in one place, it makes a treasurer's life a lot easier. And so that's our ultimate goal, is to get to that customer outcome, which should be everybody's ultimate outcome.
Yeah, again, what can I add? This whole topic of cooperation between fintechs and banks, I believe, has been discussed so many times. My view on this is cooperation is great. It needs to be a partnership. And this partnership needs to make sense for all involved parties: the bank, the fintech, the client, in 3 dimensions: commercially, operationally, and technically. Everyone needs to be happy in all these 3 dimensions. And you need to identify a soft spot where you identify an opportunity that this really makes sense. And in that case, yes, it is a successful cooperation. There are clients who love to cooperate with a fintech. Actually, they are approached by fintechs, and then they will approach their bank and say, well, I would like to work together with this fintech. Can we put something together? And sometimes it works, sometimes it doesn't. Then there are other clients who say, by all means, I don't want to work with a fintech. I want to stick to the bank. It's also kind of a relationship management aspect. And that also needs to be accepted, right? So there are clients in this direction, client that direction. We have yesterday discussed a new concept which is called currently and I emphasize currently, inventory finance. This is a concept where you definitely need someone in the middle. I think that's a great opportunity and a great example for a cooperation between banks, and I'm not sure whether it necessarily needs to be a fintech, but it needs to be a kind of independent vehicle, let me put it that way. I'm still kind of not too happy with the term inventory finance, but that's another story. We're going to look into that. But I think that's one of the great opportunities which we have in front of us and something to be monitored.
Thank you, Chris. Yeah, as you mentioned, there's a lot, and I think of technology, AI, that could be taken into account, and that's the next question, which is regarding this topic. We hear a lot about AI-driven risk management and improved data visibility in SEF. Beyond the buzzwords, what real improvements are you seeing today within supply chain finance, and what will matter most over the next 12 to 18 months?
Yeah, sure. Yeah, so I think AI continues to evolve at such a fast rate that if you ask me in 12 to 18 months, my answer will definitely be different. But I'll pull out a crystal ball just for fun for the next 12 to 18 months, and then you can ask me about it later. I think already we're seeing AI being leveraged for supplier segmentation and optimization and figuring out which suppliers are going to be best case for supply chain finance programs, and working with corporates on better identification and practices to get those suppliers adopted into programs. That's already happening. Next level and sort of stage through that is, and I think we sort of already touched on this a little bit, is the friction reduction that we can apply across the board at sort of every stage gate. And I like the framework of commercially, technology-wise, and structurally. And you can start to apply that across the board. Integrations is going to be a big piece of that, where you have these big, hairy monster corporates, Fortune 100 companies who run dozens of ERP instances and have multiple business units, many cross-border, and sort of compiling all that down into a simplified matrix or way that you can map that into a system, and the system's running this automatically to make sense of all that data and reduce errors in that data as it comes in. AI is not going to be immune from bad data in, bad data out, but it does have, I think, the ability to put a lot of practice into processes that are currently manual and sometimes breakpoints for organizations to be able to move forward, because the cost to do it at the scale and the way that it needs to be done, it's too complex to do. It has the ability to do that at a scale that we can do much, much bigger and much, much faster to really simplify and make the transparency and sort of wrap it all the way back around to the transparency and simplification that's going to enable the growth moving forward. So I think that's the biggest piece in AI. Next stage is sort of the mid-office to back office business functions that need to happen that can be automated and make the friction really sort of go away for standing up large programs at scale and at speed. And that's going to be a really exciting future for the next, I would say that's 8 to 10 months versus 12 to 18. But
100% agree with everything you said. What I'll add to it is I think this has been incremental. The change that has happened has been incremental, not revolutionary. So what I mean by that is in institutions, you've seen the application of AI slowly being integrated, right? So using it as a way to look at what suppliers are using invoicing in certain ways from a risk aspect. Well, what's happening with the volume of invoices coming through, the utilization? Are there any anomalies? Calling those out. And it really gives the power for like risk teams to look at it and say, this is what I need to concentrate on based on the data that I'm looking at. So it's really been incremental, taking out again that manual process and making, leveraging the technology base that's coming with it. But I do think that in the next 18 months, let's say, what we're going to see more and more is the data quality. That's really what's going to matter. We have to have clean data that's investing in cleaning the data, regulatory aspects, driving that forward so that we can have the right analytics in order to see what AI is bringing to the table and able to see what's actually happening with our supplier base. So it's going to be key for the data point.
Thank you, Hara. And I think in the same line, maybe just getting a question from the audience. Maybe Chris, in this sense, or anyone. Do you have any high-level data on what percentage of the transactions in payable supply chain finance programs are domestic versus being cross-border?
Yeah, very interesting question, and I'm happy to address that. The simple answer and very quick answer is no, but I can share some rationale behind that. So first of all, and maybe I can also address the second question, the typical nature of clients on the buyer side who are using supply chain finance programs are large MNCs. That's the typical audience of these programs. We are trying to trickle it down into smaller client groups, but that's the typical customer, the big blue chips of this world. And that automatically also means you will, of course, find a certain extent of domestic transactions, but due to the nature of this business, you will also find a lot of cross-border. How exactly that is sliced and diced, I cannot tell you. There are no industry studies. Maybe let me quickly elaborate on that. We have done an analysis in 2021 in the Global Supply Chain Finance Forum I'm chairing on metrics, because there is obviously a very high interest in what is the volume of the market for supply chain finance. No one knows, because it's discrete data. No one is publishing anything. There is no public register. There are estimations in the market, of course. There is also the ICC trade register, where approximately 20 banks contribute. But there is no complete comprehensive overview on these data. So everything is kind of estimated. And I would say, depending on the region, on the industry, on the provider who is offering these programs, the ratio will probably vary, I don't know, somewhere between 20 and 80%, just to give a ballpark figure. I don't know.
I'm surprised you answered that question. I thought you were going to go more for is supply chain constrained by regulatory scrutiny or by weak supplier level data? And I feel like I touched on that since, I'll call it out now since we're on it. It's a bit of both, right? You have to have that regulatory vigor as well as data, right? Good data drives the analytics and correct analytics. And that's what we need to be able to scale a supply chain finance program effectively, right? We can't take that for granted.
Great. And in that sense, staying with you, Yahaira, I would like to ask you, with so many fintech providers, what are the main criteria for a bank to select the right fintech partner?
That's a great question. I think it's a lot of aspects. The technology they're bringing to the table, how long they've been in the market, right? Are they coming to us with clients? Are clients asking us for that particular fintech? So it's a wide variety of different data points that we need to know in order to see who do we want to partner. And it's not going to be one partner. There may be multiple partners, right? So it's just about what's in the market, who's coming to us requesting it, and if they're coming to us, what are they coming to us with? What's their powerhouse? Do you want to add anything to that, Caleb?
You want to add something, Cale?
No, I think you said it well. I think in my experience with, if I answer the same exact question from the fintech's point of view, I think that's spot on. It is, does the technology meet the requirements that the bank is looking for? Is the fintech doing its own origination? I do think as we will continue to see fintechs pop up in this space, time in market is going to be a consideration that needs to continue. You want the resiliency, you want the consistency. And I think like those are probably my big three. And from the opposite standpoint, from a fintech looking for a bank to partner with, I think it gets much easier. Can you service the needs of the customer? Do you have credit to apply to this name? Like those types of things get much easier. But I do think, yeah, I think you were spot on with the answer.
Thank you, Kale. I think I will skip one question that I had regarding nearshoring in order to have enough time with the audience to have more questions. So the last question I prepared is a practical advice for institutions. If you had to advise a financial institution or corporate looking to future-proof their supply chain finance strategy, what are the 2 top priorities they should focus on in 2026?
I'll go first since I have the microphone. So number one is going to be agility. So 2026 is already sort of poking around at being an exciting year, and seems to continue the volatility coming out of 2025 to some degree. So I think agility is going to be the biggest one. And then the thing that's going to contradict that is going to be consistency. So you sort of have to remain consistent while also remaining agile at the same time. And that's the paradox that's going to be in the industry moving forward. So there needs to be a consistent level of service, a consistent ability to fund the deals on an ongoing basis and work with the same customers and partners, while being agile to respond to the individual needs. So I think those are the 2 biggest things when you're looking at how am I doing supply chain finance in 26 and through 2030. It's going to be those 2 pieces.
I'm going to add on to that, and I'm going to stick to my data. So we need a strong foundation in data, clean data. That's investing in clean data, strong, standardized data analytics, right? And this is including the regulatory aspect, making sure that we're partnering, right, across the board. From a client perspective, partner with procurement, partner with risk teams, partner with your supplier engagements team. Make sure that the data there is clean so that you can move forward and really scale on supply chain finance programs and have that strong base overall. And the other one I'm going to mention is be strategic. It's no longer just about the DPO, right? You want to stabilize your suppliers. You want resilience across your suppliers. So really be strategic. Bring that forward.
Right. Let me add the my industry view on that. So my recommendation to financial institutions would be watch out what's happening on the regulatory front. I'm based in Frankfurt, which is in Germany, in Europe. There are developments in the regulatory space that aim towards a full due diligence obligation for suppliers in a payables finance program. We all know that doesn't make any sense, but this is something which is currently being discussed, not only in Germany, but potentially also on the European level. We are doing a lot of advocacy work towards the regulators. We hope that we can resolve that, but I would say we are still in a very critical stage. In Europe, we have a change coming in. There's going to be a European anti-money laundering law effective July 27. And my personal impression is, while there is the law which is formulated, but the regulator himself, the anti-money laundering authority, which coincidentally also sits in Frankfurt, have not made up their mind about the ramifications on our business, supply chain finance, because they are simply not aware. You know, I mentioned in a panel yesterday, with supply chain finance, we all know what supply chain finance is here. But when you look at it from the outside world, it's, to be frank, a niche and a niche and a niche, yeah, because when people think of banks, they think of, well, credit savings. Maybe they think of corporate banking, that's usually cash, which is the room next to us. But trade finance is already a very small universe, and supply chain finance is a universe in that universe. Yeah, if I speak to trade finance people who have grown up in the old documentary world and tell them what we do in supply chain finance, they oh wow. And you need to keep that in mind when speaking with regulators. They are simply not aware of what we are doing and how their regulations impact our business. The other point is also regulatory, late payments. That's something which is being discussed in several countries, not so much in the US, but in the UK, in Europe, in Australia historically. I don't think this is going too far, to be frank, but because there's a lot of pushback, but still something to be monitored. The other point I would recommend to monitor and observe is alternative solutions in the supply chain finance space. I already mentioned the concept which is currently referred to as inventory finance. It's an interesting one, and I would say we are in a very early stage, but it needs to be closely monitored, it needs to be safely developed, and it needs to be looked at from various angles, in specific from a disclosure perspective and accounting perspective. A lot of unanswered questions. We will have to see how this is going to evolve. I don't know, right? I just recall we had this discussion on the IPU in the past, the independent payment undertaking, which is also seen very critically in the accounting world. This concept looks a bit better, but we don't know how it's really going to hit the road in the future, whether it's really going to be successful from an accounting perspective. We just don't know. Yeah, but we're working on that. So all things which are interesting developments and to be looked at.
Thank you, Chris. Well, we have almost, I think, a little bit more than 5 minutes. If we want to get a Q&A from the audience, if someone would like to ask something, please raise your hand. Yeah. Well, I think maybe I will pick one of the questions. I don't know which one would be better. There are a lot of questions. I think the last one is interesting. The ability to leverage on supply chain finance to do deep tier supply chain finance. Any success stories with cross collaborations amongst banks? Who would like to answer that one?
That's an interesting question. Okay, so collaboration across banks. Yes, there's definitely partnerships across banks. And my head right away goes to distribution, right? And what we do with our banking partners there. So we're definitely working with other banks and bringing them in as partners through participation. That's one thing that I'm seeing in the market. I don't know if I could add a lot more there, but definitely that's what I'm saying. And that's what I think of when I think of banking partnerships.
Yeah, I can't speak to it from a banking collaboration standpoint. That's not really how we look at it. We certainly have experience and some good experiences and continue to explore this with, particularly in the automotive space, some large corporates. But the deep tier supply chain finance position is a really interesting one. And so I think it's something that continues to evolve. And there are some small examples out there in the market where it has worked and continues to work, but those seem to be not scalable right now. So it's definitely something like I'd love to have a conversation with whoever's asking about that later, because it seems like a very specific question that you have something in mind. But yeah, we have some examples where we know that deep tier SCF works, but it's certainly not commonplace. It's not a common position.
I think in the same line, just picking another question from the audience. Have you seen situations where I didn't see now the question. It was the last one. No. Have you seen situations where AI simply automated disruption versus looking at the current workflows, bottlenecks, etc., in supply chain finance?
Yeah, maybe not end to end yet. I think that's sort of early stage. The beauty around AI in this is that if you can perfect the decision tree, AI can really start to automate and reduce friction. And so I think that's a piece where if we can standardize decision trees, you no longer have to standardize for every single customer. You can just standardize the decision tree. And that allows you to scale at speed again, the ability to do sort of customized work with each different corporate, and every corporate has their own personality and behavior, and they need that level of customization, whether it's integration or service or working with the suppliers in the supply chain. So I think that's where at least we are today, is in perfecting that decision tree and working at each stage gate in the workflow of SCF to start automating the business processes that go along with it. So end to end, certainly not. We are seeing it to start to disrupt and reduce friction in that workflow on a regular basis. It's just a matter of sort of tying all the different pieces together. So it's definitely a focus for us this year. So I'm sure it will continue to be a topic around.
Thank you, Kale. I would like to move on with another question to Chris. What is your view on the need for more standards and rules in supply chain finance similar to the UCP, URF, etc., from your perspective?
Ah, there. Okay. Okay. Good question. Well, I would say we have standards which have been published by the Global Supply Chain Finance Forum. They are public since 2016. We have even added a couple of standards. We have also discussed the option of having ICC rules, which would be an equivalent to UCP or etc. for supply chain finance. We did a study on that, which was actually then. We started out with saying, okay, let's create rules for supply chain finance, but the ultimate conclusion from this paper was it's not the time. And in fact, we do have standards, and there was no real need to create any rules. So I would say we have enough standards. There are best practice documents out there. There are standards, there are descriptions. So I would say we are fine so far. But of course, we monitor the market. And when we see something's new coming up, then we debate, should we formulate any new technique or description or whatsoever, which is what we are now doing, for example, with inventory finance. Just to give you an example from the past, when we had published the terminology and we had these two categories, receivables purchase and loans, we came to a point where we then said, well, what about this other concept, IPU, where you don't purchase a receivable? And we had a long debate on where we put that, because initially it was intended to be a variation to payables finance. But I said at that point, look, in payables finance, I purchase a receivable, and I cannot put a variation into this technique where I don't purchase a receivable. That doesn't make sense. So we created the technique description for corporate payment undertaking, we called it, but put it in a third category, which we called advanced payments, where you will nowadays find corporate payment undertaking, dynamic discounting, and the bank payment undertaking. So it's a kind of fluid universe, and we are looking at it, but it takes a while until it really is established as a industry standard.
Thank you, Chris. Well, I think with that we are closing the panel. Firstly, I want to thank you, everyone, for a thoughtful and forward-looking discussion. I want to thank Christian, Jahaira, and Kel for sharing their expertise, and all of you for joining us and contributing to this conversation. Enjoy the rest of the conference, and thank you for being with us today.
Thank you, Ruben.